Did you know since COVID, 6 years roughly, the American dollar has lost 25% of its value? This episode, we're going to talk a little bit about that, which is inflation. And for all the folks out there, we have many podcasts. We've got now dozens of podcasts, and we've got different, if you want to go back, we've got different aspects on how to fight it, different assets. But we're just going to, right now in this, kind of just talk about the past, present, future of inflation, why it's important, and potential predictions.
Okay, so obviously we have that 25% in the past 6 years, and that kind of gives you a framework. So that's eating your returns as an investor. If you have a big pile of $100,000, you're losing $5,000 a year, roughly, from inflation. It's getting stolen from you in purchasing power, like a little, like a leaky bucket. You got your water, but it's leaking out. Like what the? How do you stop that leak? Yeah. Keep that water in there. So yeah, I mean, to have an idea, so we want to kind of be thinking with the whole picture as an investor, and we actually want to start with the history of inflation in the United States, which was 1800s to 1900s. Broadly speaking, no inflation. So a penny could buy you, a couple pieces of candy back in 1800. Penny could buy you a couple pieces of candy in 1900. No loss of purchasing power. Obviously, the creation of the Federal Reserve, the credit system, all that sort of stuff. Now it takes $1 to buy several pieces of candy. So you've lost 100 times your purchasing. But if you had, $100 back then, and you could buy, say, a small car or something like that. You could obviously it takes $10,000 to buy a small car, a used car, or whatever like that. Now, roughly, 100x inflation since that time period. So, as an investor in the 1800s, you would act very differently than an investor in the 1900s. So it definitely affects whether you're gonna be doing fixed assets like bonds or money market or savings accounts and that kind of thing, as opposed to protecting yourself from inflation with the Bitcoin, gold, land, stocks that are inflation resistant, like retail and stuff like that.
Very important dates here. For me, I can just say two important dates I think we should definitely hit on. Number one date is the Federal Reserve when it came in.
1911?
Yeah, in 1911. Yes, I forgot to say that. And also going off of the Bretton Woods, the gold pegged to the dollar. Those were two.
1973, you mean?
Yes, exactly. Bretton Woods. Nixon took it off the gold standard. Those were two huge, and you folks, we won't do it here, but for your own homework, go into it and look at the inflation rates straight after those. Two things definitely went up. Commodities went up, gold went up, and those were two very important points on having almost a hyperinflation type environment. Not quite hyper.
Yeah, well, hyperinflation, I think you generally agree upon to be about defined as like over 100% of inflation per year, which we've never had.
No, not hyperinflation, but let's just say
much higher.
Many times inflation to what it was.
Yes, much greater, heading towards hyperinflation. Yeah.
So you want to talk a little bit about the Federal Reserve or no?
No, I think it is what it is at this point. As an investor, you just need to live with it, obviously. So yeah, we're not going to cover the Federal Reserve in this video very much.
Okay, so Dylan, I guess here's the next thing I wanted to kind of bring our thing in. So we know that inflation has been creeping up. It's in the news, obviously. The Federal Reserve does have a goal of 2% inflation that they think is a healthy, quote, inflation.
They only steal 2% of your money per year. They're nice guys.
Per year, you know what I mean? We don't like the rules, folks. They do.
You don't even notice them stealing out of your wallet.
Yeah, so the factor is you need to essentially beat that. So very hard to beat that through just working because you're going to have to continuously get raises while things go up. You know what I mean? So you can, some jobs do give you a 2% raise every year for inflation, some don't. But we have figured out different ways of using your capital to, instead of assets which go like this, which is normally fiat currency, most currencies in the world are fiat, I think. I don't know. Do you know of any currency, like I'm talking about national currencies, world currencies that aren't fiat? They're pegged by something? I don't think so. I don't think so. Yeah. So we can agree that just keeping the money in your mattress is not a good idea. In fact, I'll tell one quick story here. There is a person I know whose mother had put like $20,000, which was a huge king's ransom back in the 70s. If you look at that, that was maybe worth $100,000 today, roughly. And she still kept it in there. Think of what that $20,000 gets you compared to before. Better off putting that in the market, or better off putting
gold. Gold would have been safer, and she would have had way more purchasing power than, probably would have grown. But
yeah. And normally interest rates do not because they normally lag. So you're normally losing out on government interest too. So that's definitely something we want to kind of see. So in terms of the present, right, we're seeing inflation at about, again, this is government statistics, about 3 to 4%, roughly.
More realistic would be about 5% if you kind of looked at you follow the price of say beef for the last 10 years, 5% would be a little bit more realistic with fluctuations. Obviously, supply side inflation is mixed in with the actual not deflation, not deflation, degradation of the dollar, inflation of the dollar, basically. So you have that mixed in, but if you use like a price of water, beef, or whatever, and you follow that price over the years, you'll see it's more realistically around 5%. So
Yeah.
obviously some are deflationary. You have like buying computers, goes down over time in terms of like per megabyte or per gigabyte or whatever your performance numbers you're putting in there. There's different deflationary things, AI, whatever. There's different inflationary things that go down that become cheaper over time, but most things, fixed labor, fixed commodities, this sort of thing, will go up sort of following inflation. The more money gets printed, the more money is needed to buy one, barrel of oil or whatever.
Yeah. And Dylan and I, we don't talk about this as much because that's more finance, but I think it is. I always look, and Dylan and I point out, we haven't talked about this lately, is M2 money supply. How much money is actually out there printed in the cyberverse, real dollars or whatever. And normally when the Federal Reserve starts printing press and starts printing more, of course, the dollars loses scarcity and it devalues it. So, and you've had a lot of the printing press, especially during COVID, where it was just, money was being given out, those $1,000 checks, all the stimulus money, et cetera, which caused that. I think we're at, again, this is government statistics, like 9 or 10% inflation.
Yeah, 9 and change.
That was
print that we saw back then, which was kind of like shocking.
Which is ridiculous. But
yeah, and that's their official number. So the real number was probably a little bit more like 12% or something.
Sorry, Dylan, did you want to expand on it, or did you want to go on the future or anything else?
Yeah, I mean, you can definitely get into like a little bit more nitty gritty details in terms of like, how to monitor current inflation, like you said. Use a government's number. You can use other different organizations, whatever number. You can use the Berger Mac, the Big Mac Index, which is more for international, but you can kind of use that over time as well. How much was a Big Mac in the 80s, the 90s, the 2000s, whatever, and that's a pretty decent
gasoline, oil.
Gasoline, yeah, now you get fluctuations with innovation and stuff like that. So you kind of want to combine it with a sort of like a smooth basket, like the way the government does. A basket of different corn and gasoline and water or whatever to kind of get a smoother picture. And that they probably lie a little bit in their numbers because that's not I think in my experience and other people's experience, COVID was more than 9% inflation in my our experience. So. But anyways,
that's a good question. Sorry, what do you think you use? I mean, you mentioned Big Mac, you mentioned other things. What do you think is the most? I mentioned M2 because it's money supply or whatever. But what do you think are the good measurements? I mean, what the best out of the ones you named?
Yeah, I mean, if you have good memory, I know you have really good memory. I have really good notes on the finance, like my spending and whatever those sort of details. So I try to use that as, and again, it's just the inflation, my inflation, meaning like I don't rent. I don't go to theaters, for example. There might be more. I don't go to college, so there might be more inflation in theaters and college and various different. There can be inflation in different like pockets, deflation, different pockets. You kind of want to, obviously, ideally, from an economist viewpoint perspective, you want to have a sort of broad spectrum of it. I do not have that personally, obviously, because I don't do a lot of things. But just what's money cost? What is rent? What is a mortgage? What is utility, like things that everyone has, insurance, food, things that virtually everyone has. I think I'm also like everyone have that as well, and like to use that to kind of get. So my rough guess based on my experience and tracking that and all that for some years is about 5% a year is what it's been.
Yeah. Or another good thing I've also heard of is just a suit, like a very nice suit. A suit.
Oh, a suit. Yeah. There
suit and tie, etc. They were wearing suit and ties in the 1800s or whatever. How much of that, a nice suit and tie, how much was it in the 1890s versus today, right? Nothing's really changed of it. I mean, obviously, probably should get a little cheaper because you're using foreign labor. But,
lower paid labor, yeah.
Yeah, lower paid labor, but something like that is another kind of good indicator on, at least definitely in the U.S. for sure, on what what it particularly costs. Or so, yeah, those are good kind of barometers for it. Now, I guess let me ask you this for the next upcoming. We're now in the present. I mean, how do you see present inflation overall? Obviously, we saw it at like 9% or so during COVID. I think we can agree it's slowed down since then, but it's still not. We're definitely not in a deflationary environment. Nor would I say we're in a super high as we are before. I don't know what you think. What do you think of just today overall?
Yeah, I mean, it's definitely gone in the right direction in that it's gone, from the peak of the 2021, almost 10%. The official number has gone, quite a bit down into like the threes and twos area, which is a little bit more. I think it should be zero. I think they shouldn't steal any money from any of my purchasing power from me. But at least it's not as bad as 10% inflation. That's causes a lot of issues. 2% is functional. You can still outproduce their thieving basically. So it's not too difficult of a bar to clear.
Okay. So you're seeing it as what do you think it is right now?
Honestly, I would say average 5. I would say it's a little under 5 now. I mean, you had gas dip recently. I would say it's probably not lined up to be 5% for the year. In my estimation, it's probably more like 4%. I would say, based on like the things that I buy and stuff like that. So I think it's headed in the right direction. But like, if you look at the long-term drivers of inflation, the big beautiful bill has boatloads of government debt in there. Expanded the debt ceiling and all that sort of stuff. Is really not. I'm really not hopeful that it's going to keep going down to like 2%, 1%, 0%. Like that trend is very unlikely to continue.
Yeah, and that's why Dylan and I, well, especially Dylan, wanted to talk about this podcast because we don't see it going down in the next foreseeable future, just with the way government spending is, and with the way the dollar is, et cetera, how destabilized it is, and how it's losing its. We're talking about U.S. here, and it probably goes for other countries too. How, especially in the West, are kind of losing their way in terms of fiscal responsibility. You're just seeing a lot of spending still, on useless wars and just like you said, the big beautiful bill, et cetera. Every administration says we're going to fix the debt, and they never do. Or they do very little. I think the last administration to actually have a surplus was. Clinton administration, I think, during the 90s. Could be wrong, but I don't think I am. And that was
Clinton.
when I was a kid. We're talking about like 1996 to 2000, 30 years ago. And it's just gone. I think the debt there was 3 or 4 trillion. Now we're up to 40 trillion. So literally 10 times the debt in those 40 years. It's not going at a very good pace. And any time, and this is where interest rates really come into play, is that like when you got a credit card, right? It's not so much the balance, it's how much the interest payments are taking out of your check or whatever. In this case, for the government, it would be like your revenues coming in, right? If it's taking up 10%, you can probably deal with it. 20, 30, 40% on basically a non-service, you're just taking it off, taking that off the top. Very, very dangerous for any type of society to kind of survive on that.
Yeah, it's obviously not sustainable to keep paying more and more interest on the debt and stuff like that. And it's a little bit funny because it's a little different than credit card in that you can always print your way out basically from the government's perspective. They owe money to mostly this is like banks and people in the U.S. The majority of the debt is to people in the U.S. High net worth individual banks, pension funds, all these stuff that are required to hold U.S. debt. It's a very small percentage of foreigners that hold our debt. So we can always just go run the printing press and pay off all the debt. That causes other issues, but we do have that power to digitally produce all the money and pay off the debt. There's not really there's downsides to that, but we have an unlimited supply of money. So I'm not worried about the government like running out of money, so to speak. But there's a lot of negative issues if that trend were to keep going, basically, where they're paying all this interest and the inflation sort of it kind of automatically goes up as that gets reaches a certain point, basically. Right. That spiral.
Exactly. And I guess there's a few ways you can protect it. Dylan and I have, both different assets how we protect it. Obviously gold and silver, because you can't just print gold.
Can you go a little back from the screen?
Oh, sorry. You can't just print gold and silver. You can't just print it. You can't just print it.
Can't print Bitcoin.
What's that?
You can't print Bitcoin.
You can't print Bitcoin. So those are ways. Obviously markets are intended to grow. So having in the S&P 500 is definitely probably another good way.
Yeah, think about that $20,000 that the lady had under her mattress. She put in the S&P 500. What would that be now?
Yeah, millions.
Probably like 5 million, 5 to 10 million. I would guess off the top of my head.
Yeah, millions. She'd be a multimillionaire instead of just having that in there. So it's not good to be uncomfortable and not trust market growth assets, for lack of a better word. And we're not telling you to do something. We just have our favorites, or you can do, like I say, a basket of stuff. You put a little bit in gold, a little bit in Bitcoin, a little bit in S&P 500.
Real estate, obviously, you
Real
can buy
estate, real
land.
estate is great, most of the time. Yeah, we didn't even really talk about real estate. Like real estate is something that has traditionally, because you need to live in a home, I'm living in a home, you're living in a home, etc. And most people, they have to pay their rent, or whatever.
Or
So
mortgage.
mortgage,
Or property taxes if you have your house paid off. Yeah.
yeah, or property tax. So those tend to be very inflation proof, for the most part, especially owning households. So owning a house. So yeah, that's another way to protect yourself. So we've got Bitcoin, we've got gold, we've got real estate, we've got stocks. That's
Yeah.
four different. What's that?
Yeah. Those are
That's
four powerful tools.
That's four
Yeah.
powerful tools. Can you think of any others, Dylan, or no?
I think I mean, there's obviously other niche, you can buy commodities, there's other, you could invest in other, you could put in currencies that aren't getting debased if there were any, there's other strategies as well, but those are four pretty simple, understandable ones that anyone can do. And, think with whatever, pretty good tools to start with.
Yeah. I mean, and this is where I guess I don't know where I'm going with this really, but it is important is that you kind of have to look at government policies to see what they're not saying, but what they're actually doing with the dollar.
Yeah, Trump, we're going to pay down the debt. And then he writes this big, beautiful bill that has like $5 trillion of a debt ceiling. Like,
Yeah. Or
mouth is doing one thing and his hand is doing something else. I'm not the worst critic of Trump, but that's just the reality of it. His mouth said he's paying off the debt and his hand didn't, it just made it worse.
Or like Biden or whatever, and take the other side, give a little bit, is that like he weaponized the dollar against Russia and Ukraine, etc. So, I mean, what are you going to do then when you start weaponizing your currency or freezing bonds?
Yeah, it just hurts the currency. It makes every country incentivized to get away from the dollar. So that makes it even worse for inflation because now your inflation is contained in the country.
Yeah. So you definitely need to, I mean, I wouldn't spend every day looking at policies, but you actually definitely need to take at a broad range of, how the government is really fiscally responding to their Federal Reserve, in my opinion.
So what do you think in terms of your predictions of inflation in the United States in the next 1 year, 5 years, 20 years? Like, give me your expectations in your head that you're kind of thinking with the data you have now.
Yeah, the data I have now, and I'm just going through my head, and we've talked about this, is that as soon as the society hits about 25 to 30% of that, I call it credit card. It's not really credit card, but 30% of your revenues incoming are being paid for the interest, not the debt, the interest or whatever. That's when things start you need to start doing either major cuts or just do the printing press. So going under like current spending, that shouldn't be for another like 20 to 25 years. So there's some time to correct it. But again, through bad decisions and just looking at the way things are going, that could be 20 years. But I would say personally that it's going to go a slow whimper rather than just a complete collapse. Like in 10 years, things are going to get progressively, it's going to be the most famous thing to complain about. Bills are going.
Everyone's going to complain about inflation.
Yeah, I mean, I don't know about you, but I always see it in everybody just at the grocery store and talking with people in the grocery store, and just anecdotally, people saying, or I'm asking, hey, have things ever been this bad? And they go, well, not really, because you're being hit on like 4 or 5 different things. And I'm not turning this into like a complaining pity party, but they're saying that, well, look, when we had high inflation in the 70s and things, you still had like decent paying jobs, right? And the housing wasn't as expensive. But now you've got the housing is expensive, the food is expensive, the insurance is expensive, the dollar's losing value, and you're getting less. So when you've got all those attacks going at you at once, people feel that. So I guess what I'm getting at is it's going to be extremely hard to reverse this, because we've tried to make cuts, with the government, but you cut on one hand and then you're spending a whole bunch on a war on the other. I mean, you're not really getting ahead. So to answer your question, it's a lot of it's going to depend on the administration, on whatever administration is going to be in there. If it's
what would your ranges be then for the next 1 year, 5 years, 20 years?
1 year, 5 year, 20.
What kind of ranges are you
1
thinking?
year, okay, so 1 year is probably about the same, 4 to 5% inflation.
Okay.
5 year, maybe. I think we're going to hover. Okay, 5 year, a little bit harder to predict, but probably around the same. You know what I mean? I'm going to say between 3 and 6% inflation over the next 5 years, for sure. no question.
What about 20
Unless
years?
there is,
20 years.
let me
Oh, you finished?
curse this, is that I do think in the next 6 years, we're going to have some type of major correction where we are very much due. When that major correction is we're going to have a deflationary period where things are going to get cheaper. You know what I mean? Which honestly, I hate to say this, you kind of need those cycles now, to go up and down, because now we're in kind of just an increased cycle where everything's just going up. We kind of need that inflation
Reset.
bubble to burst. So to answer your question, Dylan, if you're I'm just going on averages. That's with the average of a potential pop of a bubble.
Let's just say the stock market crashes in 2 years, for example. So you would be like, okay, inflation is high 2 years, then it goes way down, maybe deflationary for the next couple of years, but average, you're getting 5 years, 5% over the 5 years or something like that.
Yep. But that's my guess. Now, 20 years, I mean, you're looking really far out, but I'm not too hopeful. I do think we're going to get a resetting of the system, just because I think eventually people are just going to throw up their hands and say, you know what, I give up.
So they're like, it's like $200 trillion in debt in 20 years, and then the debt payment alone. So let's say they're getting 10 trillion, and then 6 trillion is going to the interest on the debt, and you're like, oh,
yeah, that's when people just might as well move to Mexico or something, or whatever.
Sign out,
sure.
Peace, I'm out.
Yeah. Adios, amigos. You know what I mean?
I speak Spanish now, no English. I don't pay taxes anymore.
Right. So, I mean, assuming it were to get to that bad, I mean, you already kind of see people kind of trying to move out of the U.S. just because it's so darn expensive, even right now. You know what I mean? They're taking their dollars and going someplace else. So you're going to see more of that. Let me just tell you this. You're going to have a real movement of segment of the population if things get really, really bad, especially, if they have the ability to get out. So you'll see it through people.
Yeah, people like you and me can get out, obviously.
Yeah. So you'll see it through people you're going to see it through people moving out. And I guess I can reverse the question. What do you see? 1 year, 2 year, 5 year?
Well, you didn't quite answer your 20 years, so you don't really have a prediction. You're not really.
Ooh, I don't know if it's a 20 year. It's hard to look in the future. 20 years. I mean, who would have guessed AI even 5 years ago? Right? So I guess if I were to say
too much. I'll give you my 1 year, 5 years.
Too much. I don't think you can have an accurate prediction in 20 years. But go ahead.
Well, that's debatable. I think it has been done in the past, but you could say that's lucky or whatever. Like Moore's law and stuff. But but all right. Well, my 1 year is similar to Chris, also like 4 to 5%. 5 year also, again, factoring in a reset, which is seems like it's due in the next, I would say, 1 to 3 years. I would say there's going to be some kind of a reset of the market or whatever, sort of a deflationary period. And it might just be like a little correction or just this little slowdown, like a 2022, like slow down the market or whatever. Nothing too crazy. But that seems quite due. But in terms of 20 years, I honestly think that the government's gonna. I don't think anybody, like, even if Trump was Elon trying to do the Doge thing, and it's just too much pressure from Congress and the banks and all these things that I'd say depend on the inflation, that make their money. They get their money from inflation. Essentially, Congress, banks are the main two beneficiaries of inflation. Financialization, like stocks, all the financial basic sector of the economy is happening with inflation. Essentially, real estate, like getting the debt and having the debt eaten away by inflation. They're big fans of inflation. People that put debt on inflation, like buying apartment buildings with debt and stuff. And everyone has a mortgage is also incentivized for inflation, just to inflate away the value, because your mortgage payment is fixed. So the more inflation is, the cheaper it actually is. So it depends on the person being intelligent enough to know that, which not a lot of homeowners in my experience are. But so you have those factors that are pushing, and I think those will win. Even if you do have a president that comes in and he's like, hey, I'm not going to balance the budget. I think they're going to impeach him for jaywalking or something. You know what I mean? Like, I think there's too much force behind it to really win even with one administration that's super like dead set, some like libertarian, like, we will not spend more than we're gonna like die on this hill. Well, they're gonna die.
Well, do you see why my prediction 20 years is very difficult? Because what if you have
yes, I do, but I will give a 20-year prediction where inflation, I feel like inflation will go up to hyperinflation in 20 years. And I feel like the inflation rate is going to start going up into the more hyperinflation sort of area, the 20 to 30%. Like Chris said, you're going to have some exodus of people with capital abandoning the U.S. because the system's just not going to be sustainable at that point. They're going to see the writing on the wall. And they're like, whatever the hell is happening? I'm getting the heck out of here until things stabilize, reset. Because these things don't generally like get fixed. They generally smash, crash and there's a reset, like World War II or, various other things like this. These are not things that like someone sits around and says, you know what, this is not sustainable. Let's just correct things. Or, it doesn't really happen historically speaking. So I think it's going to bomb out. Basically, it's going to have a massive collapse. 20 years is a pretty rough time frame for that, but I think there's going to be hyperinflation on that route. I don't really see any way around it. So I'm thinking with that in terms of also capital controls, whether it's seizures, restrictions from getting capital out of the country. I see that kind of writing on the wall in like 20 years in the U.S. I'm not worried because I see it 20 years ahead, and I can avoid that. I'm not they're not going to keep a penny from me.
I'm surprised because you're way more bearish than me. I don't see that in 20 years. No, I'll make a prediction and say, well, it's not going to be hyper 20, 40% inflation. I have my reasons behind why it's not, but we don't have.
Okay, well, I got you to do it. Maybe I should have started, then you should have done yours.
Yeah, I should have done mine because I was just like, okay, wow, that's damn bold. So in 20 years, you think over 20% inflation?
Yes.
How about 100% inflation?
Possible, but unlikely. I would say more like in the 20 to 50% range. Okay. Not like an Argentina.
I personally, I will tell you this.
This would be like losing world reserve status at this point and things like that.
Yeah.
Or at least slowly starting the process of losing reserve status.
Yeah, I don't think the U.S. is going to do that because they've got a couple things behind them. They've got a lot of the tech industry right now behind them, and they're always innovators at tech. That's number one. Number two, they've got the big military. Number three, you still technically, right now, and again, it's 20 years. That's why it's hard. You still have the reserve currency, and normally, so you have a way of kind of expediting your debt a little bit better. You can inflate it away a little bit easier. So those are the reasons why a lot of dominoes have to fall in 20 years to cut. A lot of really bad things happen in 20 years, I think, for that to be that dire. I don't think it's going to get better though, but I don't think it's going to.
You think the pace of the going bad will be more like a 40-year problem? Yeah, we'll see who's right, but yeah, that's my prediction.
And I don't know if it's matters. Probably doesn't matter that much. We still do have like a lot of natural resources that people want. So people are gonna.
I don't think it's gonna be a problem living here. I think you just need to be prepared for it. Like I'm not planning on leaving the U.S. I'm just planning on that happening and just building my life around that. You can exit the fiat system. You can barter. You can grow your own food. There's a lot of things you can do to kind of step away and not be affected by that and still live in what I think is the greatest country in the world, despite that, believe it or not.
Perfect. I'll give you the last word. We got about a minute.
I think you should be thinking with inflation as an investor, whether your expectations are, whether they're 3%, whether they're 10%, you need to be thinking with that. And if your inflation expectations are high, you need to be not thinking with fixed assets.